How is kurtosis calculated? Have you ever wondered how traders assess the risk of extreme price movements in the stock market? One key concept that plays a role in this assessment is kurtosis. So, how is kurtosis calculated? Let's break it down step by step. Kurtosis is a statistical measure that describes the shape of a distribution, particularly how tailed it is compared to a normal distribution. It is the fourth standardized moment of a distribution. To grasp this, we first need to understand moments of a distribution. Moments are measures that describe the shape. The first moment is the mean, the second is the variance, and the third is skewness. Kurtosis is the fourth moment. Now, let's get into the calculation. The formula for kurtosis involves finding the fourth moment of the distribution and standardizing it. You do this by dividing by the variance squared. Mathematically, it can be represented as kurtosis equals the fourth moment divided by the variance squared. The fourth moment is calculated as the average of the fourth power of the deviations from the mean. The variance is the average of the squared deviations from the mean. To make comparisons easier, we often use excess kurtosis. This is calculated by subtracting 3 from the kurtosis value. The normal distribution has a kurtosis of 3, so excess kurtosis shows how much more or less tailed a distribution is compared to a normal distribution. In stock trading and options, understanding kurtosis is essential. It helps traders gauge the risk of extreme price movements. A distribution with high kurtosis, known as leptokurtic, has fatter tails. This means there is a higher chance of extreme events occurring. For options traders, this is particularly relevant. Options pricing often relies on volatility assumptions that may not fully account for these extreme events. Recognizing kurtosis can aid traders in managing risk and making informed decisions about their positions. Calculating kurtosis by hand can be quite complex. Most traders prefer using software tools or functions like the Kurt function in Excel to simplify the process. This allows traders to focus more on interpreting the results rather than getting bogged down in calculations. So, the next time you think about risk management in options trading, remember the role of kurtosis. It's a powerful tool that can help you navigate the unpredictable waters of the stock market.